Here's the paradox in Aldar's latest quarter. The developer sold less property on purpose and made more money doing it. Profit is up, revenue is up, and yet the number everyone watches for a property company, new sales, went down. If you don't understand why management chose that trade, you misread the entire quarter. Officially reported second quarter net profit rose double digits year on year on higher revenue, taking first half net profit after tax up 18% and earnings per share up to 17%. But group development sales fell in both the quarter and the half, which the company explicitly called a measured, deliberate slowdown in new launches. My read, the profit engine and the sales engine have decoupled, and for now, that's by design. So, how does a property developer grow profit while dialing back sales? The answer is the most important thing to understand about Aldar today. First, today's profit was earned years ago. Aldar recognizes revenue as it builds, not when it sells. So, the engine driving this quarter is the backlog. Projects already sold, now being delivered. That backlog stood near 72 billion dirhams. With the bulk in the UAE, and management says it underpins revenue recognition for the next 2-3 years. My interpretation, this is why slower sales didn't dent profit. The company is harvesting work it already booked. The trade-off is real though. Today's sales become tomorrow's revenue, so prolonged slowdown eventually reaches the income statement. It just doesn't this quarter or maybe next. Second, why pull back on launches at all? Management framed it as discipline in response to market conditions. My read, rather than flood a cooling launch market and cut prices, Aldar is protecting margins and timing releases to demand. The proof, it's a choice, not weakness. When they didn't launch Yas projects earlier in the year, inventory sold out fast, demand is there, supply is being metered. Third, the recurring income business is quietly carrying more weight. Aldar investment, malls, offices, logistics, schools, hotels grew adjusted EBITDA 18% to around 1.8 billion dirhams, with assets under management climbing towards 56 billion dirhams after acquisitions like the Kejat logistics portfolio and the link at Masdar City. Why it matters? This is the defensive annuity like half of Aldar. The more it grows, the less the whole group depends on the boom and bust rhythm of property launches. And there's genuine hidden positive, the international arm. Saudik in Egypt and London Square in the UK posted triple-digit sales growth off a small base, still minor in the group context, but it's the early outline of geographic diversification beyond Abu Dhabi. Does management sound confident? Yes, the chairman tied the result to years of deliberate strategy, and the company kept launching landmark projects, activating the 100 billion dirhams Marsa Al Sadiyat master plan. That's not a company bracing for a downturn, it's one pacing a long cycle. My assessment. This quarter doesn't weaken the long-term story, it clarifies it. Aldar is deliberately trading near-term sales headlines for margin discipline and recurring income growth, while a massive backlog guarantees the profit line for years. Before next quarter, watch three things: whether development sales reaccelerate as new launches hit in the second half, whether the backlog keeps growing on stars shrinking, that's a real forward indicator, and whether investment income keeps compounding. The day the backlog stops growing is the day this history actually changes. Fewer sales, more profit, and a backlog doing the heavy lifting. That's Aldar this quarter.